Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. There's a lot happening in markets. We're going to cover it all in another big episode of Equity Mates. We're going to talk about the news moving markets. We're going to look at some of the biggest asset managers in the world, core portfolios, how they build them, and we're going to compare them to how we build our core portfolios. And then we're going to close with a segment that I have mixed feelings about. I think it's fair to say Bryce's quest to turn $500 into $5,000.
Yeah.
We'll get the updates and we'll hear how it's going.
Absolutely.
Before we get into it, just a reminder, if you are new to investing, first of all, welcome to the show, welcome to the journey. But we have put together an ETF handbook to help you get started and to understand some of the key investment options you have. The link will be in the YouTube description or the show notes, free to download. So check it out if you are trying to get your head around this whole investing thing.
News and markets.
The headlines we're going to unpack today: the average house price in Australia hits $1 million. Monash IVF's shocking mix-up. AI investment isn't slowing down, and your coffee is about to get more expensive. Ren, let's get into it. And of course, we've got to start with the Australian housing update.
Yeah, so about a week ago, we came on the show, and in this news segment, we spoke about the news wasn't good for Australian housing supply.
No.
The government's own report came out and said that we were going to fall about 250,000, 260,000 homes short of the target. There was new data coming out that mortgage pre-approvals was going up, and as interest rates came down, the recipe was less supply than we need, increasing in demand, plus the increased buying capacity for those trying to buy just added up to higher prices. So this story is unsurprising, but the headline is the average price of an Australian house is now more than $1 million.
It's crazy.
If you want specifics, $1,02,500.
Yeah.
And that's from the Australian Bureau of Statistics for the March quarter, up 0.7% in just 3 months.
It's nuts. So all states and territories recorded rises in property prices in the March quarter. Growth is slowing somewhat, but overall across Australia, both houses and apartments, growth was 5.9% for the past 12 months compared to 9.5% for the 12 months before that. So slowing growth, but still growing.
Yeah. So look, Australian housing, it continues to be fraught. We'll continue to talk about it, but probably not much more to say there. Let's move on to a story that was pretty shocking for the people involved and for the shareholders that are on the ride as well.
Yeah, big time.
Monash IVF, Australia's largest fertility player, has had a second shocking mix-up in 3 months.
Yeah, so the first incident was earlier in the year, but I think that was when they found out it occurred.
Yes.
Which was when they had a woman actually gave birth to a child that wasn't hers.
Yes.
This time around, there's been another incident in transferring the wrong embryo, and it has whacked the share price of Monash.
Yeah, so it's down about 50% since the first incident was reported. It was down about 25% in a day when the second incident was reported. I think notably for people who are watching this stock closely, the two incidents happened at different labs. The first one was in Brisbane, the second one was in Melbourne. So you can't say that it was just like an isolated lab or like a problem with there.
Yeah.
Obviously not good in any sense, but it's been a tough run for Monash IVF. A lot of structural tailwinds for the IVF industry. People are having kids later, fertility issues are rising, it is becoming more accessible in some ways. but obviously not good for Australia's IVF leader.
A lot of brand damage to try and overcome here. The core of your business, you've completely cooked it.
So Mr. Beat Up, who comes on the podcast and talks about stocks that are beaten up and potentially oversold, I was actually pitching this to him as a potential Mr. Beat Up candidate. But he doesn't think it's oversold because of the brand damage. Yeah. He was like, you wouldn't go to a Monash IVF clinic. Yeah. My counterpoint is that it's actually, there are a number of Monash IVF clinics, but they also have a number of sub-brands.
Yep.
Fertility East, Fertility this, Fertility that.
Yeah.
So, it'll be an interesting one to watch. I'm certainly not buying at this point, but, it might become one that is oversold at some point.
Yeah. Moving on to our third headline, which is AI investment is not slowing down. Amazon have announced plans for an additional $20 billion investment to build 2 data centers in Pennsylvania. This really just shows big tech is continuing to increase their investment in AI infrastructure globally.
Yeah, because the important thing there is additional $20 billion. Yeah. Because in February, Amazon came out and said they expect capital expenditure across the business to be $100 billion, but a lot of that is AI.
Yep.
Meta earlier this year said $60 billion, and they're building a data center the size of Manhattan. Not in Manhattan, but
that is wild.
Google, I think it was $80 billion that they were going to spend in a year. Microsoft around that $80 billion mark as well. And so like we had all of these massive commitments, and everyone was like, wow, buy NVIDIA stock.
Yeah.
But then there was some whispers maybe about a month ago of like big tech pulling back on AI investment. We saw stories about Microsoft cancelling leases for certain data centers and the like. But the more stories we see like this,
slowing down,
where big tech are making incremental investments in AI on top of what they've already committed, it does seem to suggest that this story isn't slowing down.
Big time.
And part of the reason it isn't slowing down is AI is starting to make real money.
Absolutely. Well, OpenAI have reported that it's reached $10 billion in annual recurring revenue, which is almost double the $5.5 billion that it reached at the end of last year, 2024. So I think in a news update last week or the week before, we were talking about how many annual users they have now.
Yeah, 3 million. Yeah.
And I mean, even just thinking about how we use their products here at Equity Mates, it is just penetrating people's daily lives further and further. So not surprised to see this demand continue.
Yeah. The use cases are getting real.
Yeah.
The AI is getting better. I mean, the most obvious play is sometimes the right play, and NVIDIA seems to just be growing from strength to strength, but certainly one to watch.
Yes. All right. Well, as we have been doing for the last few weeks, finishing the news with a bit of a what the, and this comes from our daily news email, a story that we find somewhat interesting.
Yes.
Sort of a bit of a, what the hell is going on? Last week we spoke about the increase in ice cream prices, Ren, because of coconut oil. Today it's coffee.
Yeah. Well, I was actually going to start this by asking you how much you pay for your coffees these days.
I was actually spewing about this. I generally do the pod at work.
Yeah, but I've ordered your coffee in a cafe before, and I actually know how much the place charges across the road.
$7.70.
Yeah,
it's unbelievable for a strong soy latte.
Yeah, they add soy, they add extra shot. And for some reason...
that's table stakes for a strong soy latte.
For some reason, they don't give you the neighbour discount.
No, it's because I never go there.
Liv and I both get the neighbour discount.
Because you go there more than I do.
Yeah, I guess so.
You're not going to get a lot of change from a $10 note soon.
Well, no, you're going to need more than a $10 note soon. Forecasts are coffee might reach $12.
That's unbelievable.
And the reason is coffee shortages are only getting worse. So the two of the major coffee producers in the world, Brazil and Vietnam, both being hit by terrible weather. Brazil is facing the second consecutive harvest season of drought and heat wave. So the second crop in a row that's been affected. Over in Vietnam, it's facing one of its worst droughts in its history. And so put together, coffee prices are skyrocketing. One Australian coffee wholesaler reported that since November 2023, so what are we talking, 18 months?
Yeah.
Coffee prices are up 119%.
Wow.
Then you add in all those Australian factors of skyrocketing rents, higher energy prices, and higher labour costs. Also for cafes, higher insurance costs as well are starting to bite. You have all the ingredients to get your coffee north of $10.
That is crazy. Oh, I don't think I would do that.
A cheat sheet
is a quick reference guide or concise summary
Of important information.
In this segment, we look under the hood of some of the most successful investors from around the world to see what they are investing in. But Ren, today is a little bit different. We're not only...
Well, no, it's the same. We're looking at some of the world's most successful investors and how they suggest we invest.
True. Some of the biggest asset managers and how they suggest we invest.
Yeah, so today we're looking at three giants, Vanguard, BlackRock, and Betashares.
Yep.
Betashares an Australian giant, the other two true global giants, trillion-dollar asset managers. But the reason we're looking at them is normally with Cheat Sheet, we look at incredible active managers, Warren Buffett, Bill Ackman, Seth Klarman, Cathie Wood, whoever it is, and look at their portfolios and what we can learn from them. But all of these major asset managers produce model portfolios.
Yeah.
And essentially what they are core portfolios that they encourage advisors and the like to put their clients into. And so we wanted to take a look at the model portfolios from these three big product issuers and see how similar they were, how different they were, and also, probably most importantly, how they compared to our core portfolios.
Yes. So we're going to be covering three. The Vanguard Diversified All Growth Index, which is Vanguard's latest ETF, VDAL. Betashares Diversified All Growth, DHHF. And then BlackRock's All Growth SMA portfolio.
Yeah, now they don't have this as a listed ETF, but principles are the same. It's how they're encouraging advisors to invest. I think if you're on a platform, you can actually just buy the BlackRock All Growth SMA. But I think the principle we've applied here is we wanted to take the most aggressive core portfolio from each of these issuers.
Yep.
Because that's, we're young in a relative sense.
Yes.
We've got decades ahead of us, so we are not worried about getting defensive assets, cash and fixed income into the portfolio. We want our core to be focused on growth.
Big time.
So let's start by going through each of them and getting a sense of how they break up the world, like what they're investing in.
So we'll start with VDAL, the Vanguard Diversified All Growth Index. As it says, all growth, so it's 100% exposure to equities. Breaking that down geographically, 40% of that is invested in Australian equities and 60% is invested in international markets. So to break that down further, the fund has 5 Vanguard ETFs that make up the total portfolio, 40% in Australia, about 30% international unhedged, about 18% international hedged, and those are for developed markets. Then they have a small cap exposure of about 7%, and then they have emerging markets exposure of about 5.5%. So that makes up the total all growth VDAL.
Nice. If we turn to Betashares, 37.5% in Australia, 62.5% in international stocks. It's made up of 4 ETFs, and notably, not all Betashares ETFs.
Love to see it.
So whereas Vanguard was 5 Vanguard ETFs, Betashares have thrown the doors open to their competitors. It starts with the Betashares Australia 200 ETF, which is their Australian exposure, 37 to 38%. But then we have the Vanguard Total Stock Market, 40% of the portfolio, SPDR Developed ex-US, 16 to 17%, and SPDR Emerging Markets, 6%.
Yeah, love to see that. And then closing out with the BlackRock All Growth Model portfolio. So this is where they differ slightly. So 30% is held in Australian equities, around 45% is in developed market international equities, 9% in emerging markets, and then a mix of other asset classes. So 6% in global listed property through REITs, 7% in gold, and about 2% in fixed income and cash. So not all 100% global equities, I should say. A few other asset classes in there.
Yeah, so look, if you got a bit lost in those descriptions, let's break it down. Let's unpack what the key takeaways are and then compare how they compare to our core portfolios that we like to invest in. So for me, the first takeaway is how much they're invested in Australia. All of these ETFs and model portfolios are made for Australian investors, and they all have more Australian equities than I have. So Vanguard has the highest, 40% in Aussie stocks. Betashares is about 37% Aussie stocks. BlackRock is about 30% Aussie stocks. Keeping in mind that Australia based on market cap is about 2% of the global stock market.
The other notable differences was around currency hedging. So Vanguard dedicates about 18% of the fund to hedged global shares. What this means, hedging is just taking out currency risk. BlackRock, about 8% is hedged to global equities, and DHHF is 100% unhedged. So you're fully exposed to currency movements of the underlying assets.
2 more takeaways. The next one is exposure to emerging markets. So Vanguard and Betashares were both about 6%. BlackRock, a bit more exposure to emerging markets at 9%. And then finally, total holdings. So we said Vanguard had 5 ETFs, Betashares had 4 ETFs. BlackRock's model portfolio was made up of 10 funds.
Yeah.
So there's a few different divergences, but let's talk about how those compare to our core portfolios and what our thinking is.
Yeah.
So why don't you start? Which of these 3 are you most similar to?
Which of these 3 am I most similar to? I'm definitely not BlackRock because my core doesn't have any property, gold, or fixed income. So that's struck out. I would be most similar to DHHF. They have 37.5 Australian equities. I have 37% Australian equities.
Yep. Wait, you have 37% Australian?
Yeah. So the way it works is I contribute the same amount every month to all 4 ETFs.
Yep.
But because US and Australia are both geared, they consistently outrun.
And just for people who are new to the show, just quickly, what is your...
So Australian exposure is geared, GEAR. It's leveraged ASX 200. US is GGUS. It's leveraged US. And then I've got VAE, Vanguard Asia ex Japan, and VEQ, Vanguard Europe. So those are the 4. But yeah, it's actually 37% Australia, 37% US, 13% Asia and Europe.
Okay.
So I contribute the same amount to all 4 every fortnight, but because those 2 are geared, there's a consistent outrun. At the start of the year, I actually brought it back down because it was well above like 80-20, sold some of it down, put it in. But yeah, they just are something I have to be mindful of. So yeah, what about you?
Mine is not like any of these in the sense that I have 4 ETFs as well, but they're all equally weighted. So 25% Australia, 25% US, 25% Asia, 25% Europe. And I think some like notable takeaways for me are my Australian exposure is lower than all of these model portfolios. I'm completely comfortable with that.
Yeah.
I'm more than happy I wouldn't want...
It's an Australian product bias for sure.
Definitely, yeah. And like Australia has some great companies, don't get me wrong, but the world has some amazing companies. And, we're so exposed to the Australian economy in every other aspect of our life, our jobs, if we own a home, our homes, just generally the Australian economy will dictate so much of our lives.
Yeah.
It's good to be diversified.
Yes.
Interestingly, currency hedging. So none of my ETFs are currency hedged.
Yep.
I'm 100% unhedged, and I think over the long term, I'm comfortable with that. So similar to the Betashares ETF in that sense. The interesting one is emerging markets. So if you think about both of our core portfolios, because really they're very similar, except you have leveraged versions of Australia and the US. Our Asian exposure would technically be emerging market exposure. Definitely. Because China, Taiwan, South Korea, really in Asia, it's only Japan that wouldn't be classified as an emerging market. Yeah. And our Asia ETF excludes Japan.
Yeah.
So really our emerging market exposure is much higher than any of these model portfolios.
Absolutely.
Yeah, yours, or you said yours was 13%, so only a little bit higher.
So
mine's 25%.
So the fund itself, VAE, is 80% emerging markets.
Yeah, okay, there you go. Yeah.
So
I guess the concluding question, Bryce, as we look at this is having looked at these model portfolios from these big asset managers, is there anything you would tweak in your core portfolio?
I mean, the only thing for me to be wary of is just the weighting that I have towards Australia and the US, but I don't think there's anything I would change at the moment. I'm pretty happy with my core portfolio.
What do you think about BlackRock's move of having extra asset classes as part of the core? Gold, real estate, infrastructure?
I can understand it, but for me, for me, they're not bottom drawer
Gold's not bottom drawer?
Gold would be.
Gold's been bottom drawer for like
REITs, though, I don't think
14,000
bottom
years.
drawer. Unless you're going like global. I can understand it, which they do. Just not interesting. It's just not my investing strategy. I can understand it. You do see it in a lot of portfolios. But I think, as we said at the top, I want 100% growth.
Yep.
And those are not classified as growth asset classes.
Although, like, depending on the time frame you look at, gold has smoked.
Yeah, absolutely. I think my main takeaway, though, is this is a good exercise. The reason we call it cheat sheet is you can go in and look at all of these asset managers and do this yourself.
Yeah.
If you can have a fiddle around just like we do. If you don't want to buy the fund, take some inspiration from it. And tweak it to what suits you.
Yeah, I think that is a good place to leave it. After the break, we'll be back as we talk about the opposite of a core portfolio. We talk about Bryce's quest to make a quick buck and turn $500 into $5,000 in a year.
Check, 1, 2. Come on with 10 bagging. 500 to 5K. Follow the journey. Yeah, if you wanna flip the funds, Bryce will show you how it's done.
I'm trying the near impossible, which is to 10 bag in 12 months, turn $500 into $5,000 by the end of this year. Everyone has told me it's impossible, and I'm going to probably agree with them.
Everyone has told you it's impossible for you to do.
No, flat out impossible.
All right, well, give us the update.
Right.
I think if you were going to go linearly, you needed 28% a month. Is that right?
As of now, I need 28% Ren. When I started, it was 23.
Okay. Well, that kind of tips your hand. And for people who have been on the journey with you through the year, I'll give them a quick recap.
Yeah.
You rode a small gold miner, AZY, for a while, which actually went up. And then it went down, and then you sold it. And then you were riding Super Micro, the AI infrastructure player. Bitcoin got a run.
Shorted the NASDAQ.
Shorted the market around Liberation Day.
Short.
Yeah. So give us an update from where you were last time.
Update,
and then tell us what's happened.
All right, picking up where we left off, Ren, I was at $720.
Okay.
Which I think was about a 50% or thereabouts return.
Oh, from the start of the year. Well, from $500, just double it for ease of math.
Yeah.
So you were at $720.
Just under 50%.
44% return. Not bad.
Not bad. Yeah.
Not where you needed to be.
Not where I needed to be, no. I need to be in the thousands at the moment to be well on track.
Okay, well, do you want to tell us where you're at, or you want to give us the narrative?
No, I'll give you the narrative.
Right.
So last month I had 3 moves. I sold out of Supermicro.
Okay.
I was in Supermicro when Trump did his big tour of the Middle East because they announced a pretty big deal with the Saudis.
Yep.
And the stock ripped. It ripped and then it started to fall. And so I sold out of Supermicro. I was invested in Bitcoin. I've kept Bitcoin. I just know as soon as I get out of it, it's going to run.
It's hitting all-time highs again. It's back above 110,000.
Yeah. But I need it. Yeah, which is good.
Sorry.
I'm up. I need this 30% in a month, which I kind of, side note, I don't think, with all this institutional money in it, the volatility really has come out of it a bit. I think it's more of a grind.
Oh, you don't reckon it will drop?
I just don't think you're going to see 80% drops anymore. I just think the money base on it, but I could be speaking out of school.
All right, in the next 2 years, I bet you it'll fall 50%.
That's
point.
Fine. I'm talking the real 80% drops. Anyway, I'm in Bitcoin. I'm still in Bitcoin. But what I did was I sold out of Supermicro and I sold out a little bit out of Bitcoin, and I'm back into where I started, Ren, full circle moment, which is back into AZY. Now, this is Antipa Minerals. This stock has continued to run. For context, it's a gold producer or a gold mine that sits next to a company called Greatland Gold, which is about to IPO, and they have a facility that needs throughput. This stock just keeps running. So I'm back into it.
Isn't there an argument that as much as Greatland Gold, we've spoken about this before, but as much as they need throughput, Antipa needs processing, Antipa just might become a customer?
Yeah, we actually haven't spoken about that, but yeah, they could. Yeah, good point. But I think which would be also good news for Antipa.
Well, it wouldn't be acquisition good news.
It wouldn't be acquisition good news. But like so I originally bought this stock at just shy of, at 32 cents in February. It's now at 74.
So if you just bought it and held it, you would...
A bit more than double, easily. Yeah.
This is a lesson. Overtrading is hazardous to your wealth.
Kills it. Yeah. And I really got caught up in the short-term pursuit of trying to get 23% a month. Anyway, Ren, this is how the portfolio looks right now, and I think I'm going to sit on this for a bit. I'm in Antipa Minerals. The value of that is $659.34. I've made 20.33% in the past month on that. Bitcoin is $119.39. I've made 16.39% in the last month on that, and I have $5.98 in cash. Probably should just put that in Bitcoin.
Probably.
So total portfolio value, $784.71.
Okay, and sorry, just remind us, what were you at the start of the month?
$720.
$720. So you're up $64.
Yeah, so that was with some losses on Super Micro.
So look, that's not bad. 9% in a month. Like you wouldn't be upset with that.
I wouldn't be upset with that.
But it's not going to get you.
It's not going to get me. I need 28% a month.
Have you recalculated what you need from here?
28%.
Oh, okay. So that's up from 23.
Yeah. I need 28% a month. Now, if I have a great month in Bitcoin and Antipa keeps plugging away.
Have you thought about leveraged Bitcoin ETF?
I have, yeah. There's a it's T-Rex, and I think it's 3 times leverage. Yeah.
I mean, it's so stupid, but
I know. It's not a bad play.
You're going to get increasingly desperate.
I know.
Yeah.
Well, I'm kind of in a spot at the moment where I'm breaking this down into SMART goals. Specific, measurable, achievable, relevant, time-bound. Yeah. So my first one is to just double the money. That's where I'm at the moment.
Okay.
So all I need to do now is get from 784 to 1,000.
Yeah, just double it again, still not there.
I'd be close, yeah.
Double it to 1,000, double it to 2,000, double it 4,000.
I'd be very happy with that. I'd be very happy with that. The update for the next month is I'm fingers crossed just going to sit on my hands and see how this runs. You're right, a leveraged Bitcoin could be a play, but we know the downside risks with that could lose out pretty quick. I want to give a shout out to the community who are sending in ideas as well. The most recent one from Henry. The stock ticker is SNT, Syntara. They say that they're a clinical stage drug development company working to develop life-changing treatments for patients. Friend, would you believe it? He said they're dropping results this month. I'm going to keep an eye out. The results to date have been immaculate. This is not a buy, hold, or sell, but I've put it on my list to watch.
Look, as we wrap up this episode and close out this segment, all I'm going to say is this episode exemplifies the very best and worst of investing.
It does.
On one hand, building a strong core portfolio that over the long term will build wealth. And on the other hand, chasing mining explorers and biotech speckies, trying to 10-bag your money in a short period of time. The fastest way to not build wealth, as Bryce is demonstrating. All I'm going to say is I'm glad this was the final segment and we didn't put it before the core segment. I think let's leave it there.
Let's leave it there, but I'll just finish with my total return to year to date. We're looking at 56.8%.
Look, it's not bad.
I can't complain.
Full credit.
A lot of roundabouts and swings and all sorts of things.
The amount of time and effort and energy you've spent on this, not worth it, I would say.
Well, considering I only put $500 in, yeah.
We'll tune in next year as Bryce tries to turn $50,000 into $500,000. But until then, that'll do us for today. If you want our guide to ETF investing, we also have a 4-step stock selection handbook. Both of those links to those free resources are in the show notes and the YouTube description. We have a daily news email to keep you up to date with all the news moving markets. That link is also in the show notes or YouTube description. And we'll be back next episode to keep unpacking this world of investing and sharing our journey to get our heads around all the possibilities out there. But Bryce, speak to you next time.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.